Most people think retirement wealth is built by picking the right stock, the right mutual fund, or finding the next quote multi-bagger. It's not. In reality, retirement wealth is quietly destroyed by invisible leaks: fees, taxes, bad timing, and lifestyle inflation. And by the time most people notice it, they've already lost tens of lakhs. This is Vinod from NRI Financial Insights. Let me show you this with a real world case study. Two people invest the same 50,000 rupees every month for 20 years, but one ends up with almost 64 lakh rupees, more than the other, without investing a single extra rupee. Think of retirement wealth like a snowball rolling downhill. The longer it rolls, the larger it gets. But every hidden cost, fund fees, taxes, unnecessary switching, and emotional decisions is like throwing sand in front of that snowball. Let's look at the math. A disciplined investor earning a net return of 8% ends up with roughly 2.96 crore rupees after 20 years. However, an investor facing just a 2% annual drag from fees and mistakes ends up with only 2.32 crore rupees. That is the invisible thief. It doesn't send you a warning, it just slowly takes away years of your financial freedom. Whether you are a retail investor in India or an NRI abroad, what matters isn't what you earn, but what you keep after leakage. Let us deep dive into the 4 pillars of the invisible thief. They are the fee, tax, timing, and the lifestyle. The first one is the fee thief. Small costs become massive over time. Most investors don't lose money in one big disaster. They lose it in small leaks. A 1% fee on a mutual fund or an advisory account doesn't sound dangerous. But over 20 years, it's like a pipe with tiny holes. The water still flows, but the pressure at the end is much lower. In 2026, low costs equal high compounding power. Second is the tax thief, protecting the net return. Many investors chase a 12% return but overlook tax drag. For NRIs especially, this is a minefield. You have repatriation questions, currency conversion losses, and tax rules across 2 different jurisdictions. Every time you switch a fund unnecessarily, you trigger tax. A portfolio that looks strong on paper can still fail to fund your retirement if it's leaking money to tax fiction. The third one is the timing thief, the cost of emotion. In 2026, markets are noisier than ever with AI trading and viral social media trends. This creates the timing thief. People buy after a sector has already run up and sell during a correction. But retirement wealth is not built by perfect timing. It's built by consistent participation. Time in the market always beats trying to time the market. The fourth one is the lifestyle thief or saving rate trap. But this is the most ignored thief. When your income rises, your expenses usually rise too. Bigger cars, more EMI, better vacations. This is why many high-earning NRIs still feel retirement stress. A 2 lakh rupee monthly income with a 10% savings rate is mathematically weaker than a 1 lakh rupee income with a 35% savings rate. Your savings rate is the real engine of your retirement, not the stock market. Let's compare investor A, the quiet builder, and investor B, the busy trader. Both earn the same salary and invest the same 50,000 rupees monthly. Investor A uses low-cost diversified funds, rebalances only once a year, and ignores the headlines. Investor B constantly searches for alpha, switches between sectors, and pauses their SIP when the market looks uncertain. After 20 years, Investor A has 59 lakh rupees more than Investor B. Investor A respected the process of compounding. Investor B kept interrupting it. So, what should you do right now? Here is your 2026 retirement checklist. First, build the foundation. Ensure your emergency fund and insurance are locked in before you chase high returns. Then, core satellite approach. Put 70 to 80% of your money into low-cost, diversified core funds and keep only a small portion for satellite experiments. Next, automate your increase. Every time you get a raise, increase your SIP by at least 20% of that raise amount. Next is to audit your leaks. Once a year, check your portfolio for high expense ratios, unnecessary taxes, and emotional churn. And for NRIs, align your investments with the currency you plan to spend in retirement. If you want retirement wealth, don't try to be the smartest person in the room. Try to be the most consistent one. Comment roadmap if you want part 2 of this series, where we'll dive deep into how NRIs can specifically protect their wealth from 2026 tax laws and currency fluctuations. Subscribe and stay tuned, because in the next episode, I'm going to show you exactly how to turn this accumulated corpus into a safe, inflation-protected monthly income stream. Thanks for listening.